Ladies and gentlemen, good day and welcome to the Q2 and H1 FY23 conference call of PNB Housing Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepika Gupta Padhi, Head Investor Relations and Treasury. Thank you, and over to you.
Thank you, Mike. Good evening and welcome everyone. We are here to discuss PNB Housing Finance Q2 and H1 FY22-23 results. You must have seen our business and financial numbers in the presentation and press release shared with the Indian stock exchanges and is also available on our website. With me, we have our management team across verticals led by Mr. Girish Kousgi, our Managing Director and CEO. Mr. Girish joins us as MD and CEO effective 21st October 2022. He is a seasoned banker with vast experience across a variety of loan products, including housing loans, business loans, LAP, personal loans, among others. Prior to joining PNB Housing Finance, he was the MD and CEO of Canfin Homes Limited. We are also joined by Mr. Vinay Gupta, who joins us as CFO effective 26th October 2022. He has extensive experience of over 20 years in financial management, financial planning, accounting, treasury operations, and MIS. He was previously associated with SBI Cards and Payment Services Limited. We'll begin this call with the performance update by MD and CEO, followed by an interactive Q&A session. Please note, this call may contain certain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual developments and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 25 of the investor presentation. With that, I will now hand over the call to Mr. Girish Kousgi. Over to you, sir.
Good evening to all the investors. Welcome to Q2 and H1 earnings call of PNB Housing. I'll give you a context with respect to market and outlook. So housing industry is really doing very well. The entire industry is in sweet spot, and so is PNB Housing. Demand is quite robust. Demand which started after COVID, FY21-22, Q3 onwards, to be specific, October onwards, demand has been quite robust. In spite of intermittently disruptions by a quarter or two because of COVID second wave and third wave, I think demand has been quite robust. Real estate as a space has revived with more than 1.5 years, and this cycle would last for next 4 to 5 years. Interest rate, even though the rates have gone up in last little over a year's time, still the affordability is pretty high. And demand is quite robust across all geography, across all segments. And if you look at the industry, I think industry will be able to post a growth of about 12 to 13% this year over last year. This is about the industry and the outlook. Coming to PNB Housing, let me give you numbers, some data points on 3 parameters. One is a Q2 YOY. And number 2, H1 this year compared to H1 of last year, and of course Q2 over Q2, that is sequential. I think we need to very clearly segregate retail and corporate. To start with, I'll give you consolidated numbers and then I'll get into retail and corporate separately. If you look at Q2 performance on a YOY basis, there has been a growth of disbursement by 21%. The book on a console basis has degrown by 4%, but if you look at retail, there is a growth of 4%. In terms of revenue, the growth is about 6%. PAT is close to 12%. Yield, of course, is not comparable on a YOY. Of course, we have to compare yield on a sequential basis. Yield for Q2 at a book level is 10.7%. COF was 7.32. Spread of 3.38. NIM of 4.14. GNPA 6.06. And net NPA of 3.59. CAR at 24%, and leverage of 5 times. Now talking about retail quarter YOY, disbursement growth of 24.5%, book has grown by 4%, and if I have to talk about retail GNPA, it is 3.39, down from 3.53%. For corporate, the book has, I think disbursement growth is negative 48% because we are degrowing corporate book. Book has degrown by 44%. It was 10,250 crores. Now it is 5,708 crores. GNPA, I've given you for the overall numbers. So if you look at GNPA numbers, nothing much change in terms of the amount. Of course, the NPA stands at about 1,734 crores, which tantamounts to about 30%. Talking about H1, disbursement growth is 49%. Book has, of course, degrown by 4%. Revenue is a negative 5.6%. PAT growth by 5%. Yield is at 9.96. I think some of these numbers are common for both, so I'll not get into that. In terms of strategy, going forward, we would focus on retail. I think the story is going to be around retail. And within retail, we have two segments. One is affordable and one is non-affordable. I think there's going to be a very good focus on non-affordable, and we are going to be very aggressive on affordable. So for H2, we plan to open more than 25 branches, largely in affordable space. Today, if you look at retail book, which is about 52,000 crores, affordable is about 3,000 crores. So we want to grow that book very aggressively because we've seen that market is conducive and we'll be able to build book at a higher yield and with very low delinquency. We've seen that many companies in the industry, they're doing very well in affordable. We were primarily focusing on non-affordable segment, within the entire housing space. Going forward, our focus will also be on affordable. In terms of mix, going forward, we would want to maintain non-affordable 75% and affordable 25%. This is more on the incremental. Over next 2 to 3 years time, I think at a portfolio, we think slowly we'll start building the the affordable book. In terms of HL and non-HL, we want to reach to a stage where our HL is 75 and non-HL is 25. Today, if you look at a portfolio level, our non-HL is about 28%. We are trying to change our entire IT infrastructure, which might take about 15 to 18 months time. So this will help us in better delivery to our customers in terms of TATs, in terms of trying to integrate various APIs so that we can fast track our decision process. We had a challenge of book depletion, so we have a very strong retention team. If we have to compare quarter 2 vis-a-vis quarter 1 of this year, we were able to arrest BT out. In quarter 1, BT out was about 1,350 crores, and in quarter 2, this number is about 1,100 crores. So going forward, this number is likely to come down. In terms of total closure, quarter 1 was about 3,450 and quarter 2 is about 3,150. And this is on a growing book. This being my first earnings call, I thought I should give more time for all of you to ask questions because you'll have a lot of questions to ask. Before I open the forum for Q&A, there's one thing which I want to clarify on the provisioning, because there has been a significant increase in provisioning compared to quarter 1. Quarter 1 was 49 crores and quarter 2 is 243 crores. So this 243 crores has 3 parts. One is ARC sale, second is written off, and the third is we have provided 60 crores additional. So, and this apart, I think there has been slight increase in the ECL provisioning. So this 243 actually has four components. So you should read from 49, the number in quarter two has gone up to 80, and the rest is write-off, ARC sale, and additional provisioning. In terms of credit cost, for quarter two, it is slightly on the higher side. It's 1.54%. H1 is 0.94. And for the whole year, we are expecting credit cost to be around 1%. So I would request to open the floor for Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Ravi Naredi from Naredi Investment. Please go ahead.
Thank you. Mr. Girishji, welcome to this new company. It is bigger than 5 times Canfin Home. Sir, what will be your priority to run this company, top priority to run this company, to raise the fund, to raise the AUM, or to bring down the NPA level? And second, company AUM is 66,000 crore. Market cap 7,000 crore. Sir, with due regards to all of you PSU employees, I say if this company was in private sector, its market cap may be 50,000 crore to 70,000 crore. So where we have challenges and how you overcome from them? These are my questions.
Sure. Thank you. Thanks for the question. See, we are pretty aggressive on growth. And you will see in next few quarters, we'll be growing by a healthy percentage, which will be much above the industry growth rate, both on disbursement and book. So first, the growth will start on disbursement, and then it will catch up with the book growth. Now, while we say that we want to grow, so we want to grow in non-affordable space and also non-affordable. So we are now getting into affordable in a big way. So that's going to aid our growth story along with non-affordable segment. A. B. We will definitely bring down our NPA, GNPA and NPA. So going forward, A, we'll work on growth. That's both disbursement and book. B, we will bring down our delinquencies. Our GNPA will come down, net NPA will come down. And number 3, we will also ensure that while we do these two things, we are profitable. So in terms of margins, in terms of, we will ensure that we have a bare threshold which we will maintain. And I'm sure, if we can get back to basics and grow with profitability, with lower delinquency, I'm sure, I think, market will reward. I think that's the expectation.
Thank you, Girishji. But will you bring the new people to the company as per your convenience, or you will run with existing employees?
See, I'll tell you, we have a very good team. PNB Housing team is excellent.
Okay.
While I say that, we will always, be open to hire talent from market. So whenever there is a need and when there is an opportunity, we will also try to hire talent from market. So largely, I think the existing team is going to deliver.
Okay. Thank you very much for your reply.
Thank you.
Thank you. We have the next question on the line of Simran from Omkara Capital. Please go ahead.
Thank you for taking my questions. First of all, congratulations for the good set of numbers you have posted.
Thank you.
And all the best for your new journey in the PNB Housing Finance. Now,
thank you.
Sir, I have three questions. First is, what's the company focus on the gross NPAs going forward? Second, and second question is on the loan growth front, because we are seeing the, very, flattish sort of loan growth over the quarters. And third, where you see the cost of borrowings of the PNB Housing Finance is going to be on the peak in the upcoming quarters? Yes. Three questions, sir.
Yeah. So in terms of growth, I mentioned that, if you look at H1, I think we've grown by over 49% is the growth. I'm talking about disbursements. So book will catch up. So probably, this year we'll see growth in book by about maybe close to 10%, right? 1 year from now, or maybe 5 quarters from now, we should be able to see growth in book of over 15%.
Okay.
On a steady state, in the long run, our disbursement growth, at least for next few years, is going to be 25%, and book growth will be 18%.
Okay.
A. B, we are working on to bring down our GNPA. As I told you, the story is going to be on retail, because corporate book, we are degrowing the book, and obviously on a depleting book, the NPAs would look on a higher side. We have a plan for resolution on the corporate book, but having said that, our focus would be to try and bring down GNPA on the retail book. So you will see that progressively going forward from this quarter onwards, there will be improvement in GNPA. So it might take some time, but definitely you will see the GNPA coming down quarter on quarter from this quarter.
Great. And sir, my third question was that where you see the cost of borrowing is going to be peak for the PNB Housing Finance in the upcoming quarter?
See, we are part of the system,
yes,
and therefore we'll have to operate within the system. But today, given the context of where a company stands, definitely our cost is going to be slightly high. Today we are talking about cost of 7.32%. But when we get our growth story on, when we see that the delinquencies are coming down, I'm talking about GNPA. Anyway, we are high on liquidity, and once we improve our quality from now onwards, we will also get the cost advantage. As of now, the cost of borrowing is 7.32. I expect in next 2 to 3 quarters time there could be increase in cost in the industry by about 0.5 to 0.6%. And to that extent, we will also try to pass on that to our customers. And as I mentioned earlier, we will definitely maintain profitability. To that extent, for me, the starting point is profitability, margins, because we have very less control on cost, and therefore we would get fixated on the margins and then accordingly try to adjust the yield. And we are focusing largely on affordable from now onwards. There we have a higher yield opportunity, and even we'll be able to grow the book because we see less competition in tier 2, 3 and 4 cities vis-a-vis compared to large cities and tier 1 cities. So we have an opportunity of building book at a higher yield. Therefore, we'll be able to maintain margins. I think all these things will happen parallelly. It's not sequential.
Okay.
So on the cost front, it might go by another 50 or 60 bips in next 2 to 3 quarters time, and we are ready to absorb that and still grow at a healthy rate.
Great, sir. Great. And your focus is primarily driven on the affordable going forward, if I'm right?
No. Today our focus is retail. If you look at my retail book, it is 52,000 crores. Out of 52,000 crores, 3,000 crores is affordable. We see opportunity in both affordable and non-affordable. But today, if you see, our concentration is on non-affordable, which is about 49,000 out of 50,000. So we want to grow non-affordable space. At the same time, we want to get aggressive on the affordable space as well, because we don't see too much of a difference in the portfolio quality between affordable and non-affordable, and therefore we want to get into affordable. I'm talking about the industry. So we will get very aggressive on affordable, and we will continue to be aggressive on non-affordable. So our focus is going to be on retail, 2 segments, affordable and non-affordable.
Great, sir. Great. Nice to hear this. And sir, all the best for the upcoming quarters and the upcoming years. And wish you all the best. Thank you, sir. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question on the line of Dipti Kothari from Kothari Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, my question was on that, do we have any significant update on corporate resolution?
We have an update, but at this point in time, let me be honest with you, our corporate book is depleting. Every quarter there is a runoff, and this book is now 5,700 crores. If you look at my overall book, I think it's less than 10%. And going forward, we are going to grow very aggressively on the retail side. On the corporate side, we are working on some of the accounts. So only thing is, since considering the nature of these accounts, the resolution may take slightly longer time. So I won't be in a position to give you a definitive time frame as to what would be the resolution, let's say, in next 2 quarters, 3 quarters, 4 quarters. But we are working on resolution, so we will see that coming through in next 3 to 4 quarters time. In next quarter or two, I won't be able to commit on that because we are still working on some of the accounts.
Okay, sir. And have we taken any write-off in this quarter?
So I mentioned that out of total provision of 243, 80 crores is ECL, and the balance has 3 components. One is write-off, one is ARC sale, and we have provided 60 crores additional.
Do you have further questions?
Hello?
Yes, ma'am, please go ahead.
Ms. Dipti, can you hear us? Ms. Dipti, your audio is not coming through. Can you hear us?
Mike, we can move to the next question.
Sure. We have the next question from the line of Himanshu Taluja from Aditya Birla Mutual Fund. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity.
Mr. Himanshu, your voice is very low. Request you to kindly go off the speakerphone.
Yeah. Hello. Hi, sir. Thanks for the opportunity. My
you.
just one question is, I just missed your initial commentary, but as I've heard that your endeavor is to bring down the gross NPAs on the asset quality improvement on a quarter-on-quarter. So what sort of the credit cost we should expect over the next few quarters? And when you think our normalized credit cost will likely to be visible?
Okay, so this year, credit cost will be around 1%. And from next year onwards, we can say that we'll reach a level where we can talk about normalized credit cost.
Okay.
And this is for retail.
This is on the retail. And would you like to also build up, like on the corporate portfolio, would you like to build any contingent buffer to provision buffer?
So I think internally we're working on that. Only thing is, on resolution, I won't be able to give you a definitive timeline. Now, while we are working on the corporate book, of course, now the pool has come down drastically. On the retail side, definitely we can expect normalized credit cost from coming financial year onwards.
Okay. Sure, sir. That's the question from my end.
Thank you. We have the next question from the line of Ashwini Agarwal from Demeter Advisors. Please go ahead.
Hi, good afternoon. Thank you for the opportunity. So, 2 questions kind of along the lines asked by previous participants. So the first question is on spread. Now, if I look at your Q2 spread, excluding securitization income, that's at about 2.6%, which is kind of a little bit on the higher side compared to the previous 2 quarters. And given that now, deposit rates with banks and prime borrowers like HDFC, etc., are rising very rapidly, do you think this number of 2.6% as a spread is sustainable?
Yeah, spread of 2.2 is sustainable.
Okay. spread of 2.2 excluding securitization is sustainable in your view?
2.2 is sustainable, yeah.
Okay. The second thing is that, on your corporate book, while you've made some additional provisions during Q2, you still have a fairly large NPA pool on your corporate book, and you're talking about, some resolution. So there's 1,730 crores worth of corporate GNPAs. I just wanted to ask, what is the provisioning level on the corporate GNPA, and as this book is resolved, how much more write-off or pain do you need to take on this?
So, on the corporate book, the book is about 5,700 crores. GNPA is about 1,734 crores.
Yeah, I know, I see that. But
on this, no, I get your point. So I would say that on the coverage is close to almost about 50% on the corporate NPA.
Okay. And what's your estimate? How much more do you need to kind of wash through the P&L over the next couple of months?
No, it will be, with what I told you, it will be very difficult, for me to give an estimate, for next couple of quarters, because knowing the nature of these accounts, sometimes it will take a longer time, sometimes we see resolution coming through, and therefore I can only say that we are adequately covered. And we are constantly working on resolution, because number of cases obviously in corporate would be less. And PCR is close to 50, as I mentioned. So we'll constantly work to ensure that we are adequately covered at any given point in time, and we expedite resolution.
So you earlier in your conversation you said that for the full year the credit cost should be in the vicinity of 1%. And next
this
year,
is at a consolidated stage.
Sorry?
This is both retail and corporate put together.
Correct. Yes, I get that. And you had also said that fiscal 24, which is the next financial year, we should expect to see normalized credit costs.
On the retail book.
On the retail book. So what would be your estimate of normalized credit costs on the retail book?
Given the fact that what we have seen credit cost on the retail for last few quarters, it should be in the range of 40 to 50 bits on retail.
40 to 50 bits on retail. So if you work with a 2.2% spread, and I'm assuming your leverage will remain around 5x because your rating sort of needs to be maintained or improved, and your cost to income ratios remain under control, and 40 to 50 bits of credit costs. So what kind of normalized ROA and ROE do you think you could expect, say 3 or 4 quarters down the line?
See, I mentioned 2.2% spread as a threshold. So it could be higher. So 2.2 is something which we will maintain at any given point in time. This is a threshold. And let me also talk about NIM of 3.2. So spread of 2.2 and NIM of 3.2 is something which we will always maintain. This is a threshold. Now, having said that, even today, if you look at our spread, it is much higher than 2.2. So going forward, our spread will be upwards of 2.2. Threshold is 2.2. So you will see that every quarter, there will be definitely improvement on all the metrics which I mentioned, in last few minutes. And today we are talking about today's situation. So next 3 to 4 quarters, down the line, you will see most of the parameters improving, and even the return ratios will improve.
And so the last question is that, let's talk about the retail NPAs. You're saying that your retail GNPA ratio will decline, and it has been declining. The absolute GNPA on the retail side reached at about 2,600 crores, and it's now down to 59 crores. So it's been coming off. So what are you doing to, or can you help me understand what's driving this? Is it just the economic situation where people are feeling more positive and are paying up, and some of your restructured loans are coming back, or is there a change in the way you are pursuing retail?
Okay. The resolution in retail on the GNPA would be much faster vis-a-vis compared to corporate, number one. And within retail, we work on pre-delinquency management and post-delinquency. So pre-delinquency, we use business intelligence to identify customers who would get into stress, and we cure them before they could become delinquent, A. B, all the delinquent accounts, we start from X bucket. So we have a call center strategy, there we use self-cure, telecall, then field. Right? So for each bucket, whether it is, 0 to 30, 1 to 30, 31 to 60 or 61 to 90 or 90 plus, which is basically NPA or recovery. So for each of these categories, we have a strategy. Largely, for SMA2, if it slips to NPA, our strategy is to first try and collect. Right? Now, after November 12th RBI circular, once the account flows into NPA, now we have to collect the entire overdue, not just two EMIs, the way it was prior to November 12th of last year. Right? So that's a strategy. Now, suppose if the account slips into NPA, it gets into slightly deeper bucket, then we take the legal route. So largely, the recourse for us is through surfacing. And we use OTS as a very effective tool to try and collect. So we have different strategy for different buckets, whether it is in NPA or early buckets. So in retail, we have a very clear strategy on collection, starting from X bucket right up to recovery, which is 360 plus.
And so last question from me, what do you think will be your corporate loan strategy once you've cleaned up, the current stress that you're dealing with? Would you be a pure retail lender, or would you say that a 15 to 20% corporate book as an overall part of the book would still be desirable from a NIM and spread management perspective?
See, there are two things here. Talking about corporate, now we are very keen to A, run down the book, B, resolve sticky accounts, and once we reach a comfortable level of GNPA, then we may restart, but on a very small scale. And the proportion of corporate may not be substantial, or it will be very less. So we will be pick and choosy in terms of not doing corporate loans, A. B, within retail, especially on the affordable space, we see a lot of lift in the yield. So we see very good opportunity, and therefore we will focus on retail primarily, both affordable and non-affordable. Affordable is basically which will the growth in book could be much lower compared to non-affordable given the ticket size, but there we have an opportunity of growing the book at a higher yield, so we get better margins. On the non-affordable, we can grow the book faster, but the margins will be slightly lower compared to affordable. So it's a fine balance between affordable and non-affordable, right? And we also have a good proportion of non-home, which can get us better yields, basically focusing on LAP, NRP, and LRD. I'm talking all about retail. So all I'm saying is that without focusing on growing our corporate book from the time where we feel comfortable start doing corporate business, in spite of focusing only on retail, we have the wherewithal to maintain spread, grow the book faster, and be relevant in the market space.
Okay. All right. Okay. Thank you so much for answering my question. All the best.
Thank you. Thank you.
Thank you. We have the next question on the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity. Sir, two questions. Firstly, any update on the capital raise that we have been planning to do?
Yeah. So we are planning for rights issue. We will file before the calendar year.
Okay. And the quantum of the right issue will be around 2,500 crores.
Yes.
Okay. Secondly, sir, if I look at one of the shortcomings that PNB Housing had is the cost of funds. Our cost of fund is almost 100 to 150 basis points higher than the peers who are operating in the same segment. So how do you plan to bridge that gap over a period of time? What are the steps that you think are required to bridge this gap of cost of funds differential?
See, basically it's a journey. According to me, in mortgage business, the starting point is portfolio quality, right? So I think once we get our GNPA on track, and when we show growth with decent profitability, I think everything will fall in its place. So cost of funds, which today for PNB Housing is slightly on the higher side, I think over a period of time it will come down. And maybe a few quarters down the line we'll be able to raise from the market, at a much better rates. So it's a journey. So we need to take this course. We need to go through the journey and ensure that we get all our pieces right. Few quarters from now, we won't be talking about high cost of funds for PNB Housing.
Okay. So the focus is on asset quality, and if asset quality improves, we will automatically see.
Our focus is very clear. Our focus is on growth, asset quality, and profitability with high liquidity. This is our mantra. So these are not sequential. Everything is parallel.
Sure. That's it from my side, sir. Thank you.
Thank you.
Thank you. We have the next question from Sukriti Jiwarka from Lebanon Capital. Please go ahead.
Some of my questions around the fundraise have already been asked. So just one follow-up on tying in the fundraise and the cost of funds. So of course the asset quality and the growth will help. But I think one of the outcomes of the rights issue could be a rating upgrade.
Sorry, your voice is breaking.
Can you hear me clearly now?
Yeah, it's better.
I was saying one of the outcomes of the rights issue could probably be a rating upgrade, which would automatically give us a cost of funds advantage. And that could come much sooner than, let's say, GNPA going down and a lot of other long-term structural issues. Do you think that will be enough to negate this 50-60 bits increase that you are anticipating this year to sort of get a net zero increase in cost of funds?
Yeah, you are partly right, but I think we need to work on all the pieces because recently, we got rating upgrade, so Outlook upgrade. So all these things, I think, according to me, would have to run parallelly. Yes, definitely raising capital is a big, plus for the company. It will definitely help us to raise funds at a much lower rate than what it is currently. But yes, if we can work on growth strategy, profitability, and asset quality, I think the cost will be much lower, and we will be able to compete with some of the best HFCs in the country in terms of cost leadership.
Okay. And second question is, when you talk about affordable, you mean the Unnati kind of loans that PNB was already doing, right? You don't mean the sub 10 lakh loans that, let's say, an Awas or Housing First would be doing.
See, affordable means up to 35 lakhs. That will be a focus in the affordable space.
No, can you narrow that down? Is this because it's a very wide range, and you
okay? Let me
start into building different verticals and capabilities and teams because you don't have too many examples of one HFC doing a 6 lakh loan well and a 40 lakh loan well.
No. I think we have quite a few HFCs, who are focusing on both affordable and non-affordable space. I think as far as PNB is concerned, we are building capability. It's already on course. We will have a separate team to manage affordable business. While we are already there in the non-affordable space, we see a lot of opportunities. So we'll build a team to manage affordable. So in terms of the difference between affordable and non-affordable, one in terms of ticket size, I think more than ticket size, in terms of profile, probably, I'll give you just one example. Affordable would be basically, focusing on tier 2, tier 3, tier 4, and urban outskirts pocket, A, in terms of geography. B, in terms of profile, Cat B corporates and Cat C corporates. In terms of builder, Cat B and Cat C developer. When we talk about non-affordable, it will be focusing on Cat A corporates, Cat A builders, and focusing on top cities and metro. I think these are the 3-4 differences. Of course, there are many more. I just thought, let me give you a flavor of affordable and non-affordable. So we see opportunity in both, and we don't see too much of a difference in the book quality at an industry level. So for PNB housing, it's a journey for us. We need to definitely bring down a GNPA. We are working on that. But the book we are going to build henceforth would definitely be, at a far lower, delinquency.
Okay, got it. Thank you so much.
Thank you.
Thank you. We have the next question on the line of Amaya Gawande from Metaverse Equity Fund. Please go ahead.
Yeah, hello. First of all, congratulations first, and best wishes for the future endeavors. So I just have a couple of questions. So first is with respect to Unnati segment. What were the disbursement numbers, and were there any runoffs for the quarter?
See, I think at this point in time, talking about Unnati, because we are just starting that now. We just started, so we want to scale it up. So today, if you look at the numbers, it will be, very less. If we look at our total disbursements, I think Unnati would be close to about 11-12% of the total disbursement. But going forward, incrementally, we want to scale affordable or Unnati to, up to 25% incrementally.
And sir, about the runoffs?
We don't see too much of a difference between affordable and non-affordable at this point in time.
Okay, sir. And sir, second question is with respect to the growth you will be chasing for next 3 years. If you could just give some numbers.
So I think in my opening remarks I mentioned about this. We'll be focusing this year. The growth on disbursement would be about 40-odd%, and growth in book would be about close to 10%. Now, from next year onwards, industry would grow at about 12-13%. On book, we would grow at about 18%, and disbursement 25%.
Yes. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Franklin Moraes from Equitas Wealth Advisory. Please go ahead.
Yeah, thanks for taking my question. So in terms of, the assets sold to ARC, what would have been the gross book value and the net book value on the same?
I will have to come back to you on that. I think specific data I'll come back to you.
Okay. So would we have would some provisions would have been reversed because of the sale?
Not in the ARC.
Okay. And I also wanted to understand if we add the ARC sales and the write-offs, if we adjust for both of these things, in absolute levels, would the gross NPA levels would it have been the same, or would it have still reduced?
I think it will be on the lower side, but slightly. There's a marginal improvement. Net of write-off and ARCC.
Okay. And we have been doing a lot of, ARC sales also, recently. So just wanted to understand the pipeline in terms of the quantum. What is the quantum of ARC sales that, we are likely to do maybe in the next 2 or 3 quarters?
No, the company has not done too many ARC deals. It is the second deal. The first was done on the SR structure, which was a one large corporate account. And this is the second one in retail portfolio, which was on a cash basis. So as such, as of now, there is no confirmed pipeline. Thank you.
Okay. And on the credit cost, you had mentioned, the normalized credit cost, just on the retail aspect. So is there some concern still on the corporate book, because of which we are a little bit hesitant to give a credit cost guidance?
No, for this year I've given the numbers. So credit cost is going to be around 1%. There is no concern on the corporate book. I think the only challenge in the corporate book is that given the nature of the account, the resolution, we can't predict the resolution timeline. See, in retail I can say, suppose if the account gets into NPA within 5 months, 6 months, I can get into OTS with the customer, or I can get into illegal mode surfaces, sell the asset and realize. So I have a definite timeline. I can say within 6 to 7 months I will be able to crack. But in corporate, will not be able to give that kind of timeline. That's all. I think, but for giving the timeline, there is no other concern. Yeah, of course, the concern is that we have quite a large NPA pool. But in terms of resolution, there is no concern. The only thing is you're not able to give you the exact timeline. That's all.
And lastly, on the capital raise, you had mentioned that, you'll be filing the rights issue proposal by this calendar year. So would it be safe to assume by the end of this financial year, at least, we would have the rights issue in place in terms of getting the money?
It depends. So it might get concluded before the financial year, or it may slip to Q1 of next financial year.
So but Q1 is kind of the outer deadline.
Yeah, I would say, I think before close of Q1, probably it would get concluded.
Okay. Fair enough. Thanks and all the best.
Thank you.
Thank you. That was the last question. I would now like to hand it over to the management for closing comments.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript and the audio of this call will be uploaded on our website. Thank you.
Thank you very much.
Thank you. On behalf of PNB Housing Finance Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.